If you have ever thought about starting a podcast, using the Podcorn platform is a must. Podcorn is a marketplace that connects podcasters to amazing sponsorship opportunities and really allows you as the host to maintain creative freedom and full control of your show. Now, I personally use the platform, and I know that Podcorn helps keep you protected and compensated for all of the work that you do. Make sure to click the link in my show notes to get started with Podcorn today. Welcome to episode 43 of the Financially Free Journey podcast, and I am your host, Courtney Dyer. Well, welcome everybody. If you're new here, this podcast really aims to dispel the seemingly complex topic of personal finances and money management, debt, savings, investing, and we even talk about retirement. So if you're new, make sure to stick around because I take financial topics and I break them down into simple, easy to understand ways so you can really make the best money decisions for yourself. Okay, so this week I received an email that I want to share with all of you, which has inspired today's episode topic. So the email said, I just wanted to reach out because I recently started my investing journey to financial freedom, and your podcast has been an amazing resource. I am so glad I found it, and I'm super thankful for you passing on your wisdom. Well, thank you. As I research and become more educated, I started hearing and seeing the term REITs, R-E-I-T, if you're not familiar with that term. After further investigation, I'm understanding that it's a real estate investment trust and is attractive because of the high dividend yields and there's no tax implications on those dividends. But what's the catch? Are there any cons to REITs? They're probably riskier, yes, but as a new investor, where would you recommend we research more about these, and would it be a smart investment for a newbie? Specifically looking to invest in a Roth IRA. Thanks so much in advance. Okay, so I chose this question because I love this question, and I love the fact that this individual is really taking charge of their finances and really researching the best ways to gain returns on their money so they can really reach financial independence, which it sounds like that's their goal. I have touched on REITs in the past in a couple of different episodes, but I haven't actually dedicated an entire episode to this alternative investment vehicle. So traditionally, new investors think of investing their money in the stock market, right? Or if they're interested in real estate, then they might consider buying rental properties to generate that consistent income from the properties. Now, this can be a great way to generate consistent income, but being a landlord has a whole set of cons that comes along with it, right? Many people are going to jump in headfirst and they become a landlord because of that extra income that they receive, and they are assuming that it's going to be pretty passive. Well, however, once you actually get into the thick of it, of owning rental properties, it can end up being very costly, time-consuming, and not so passive after all. But wouldn't it be great if there was a way to get all of the pros of owning real estate, but without the headache of being a landlord? Well, that's where REITs come into play. So in this episode, we are going to go over what a REIT is exactly. I'm going to explain the mechanics of the investment vehicle. We're going to go over the pros and cons of a REIT, and then we're also going to go over when it would be good to consider investing in one. Okay, so what is a REIT exactly? Well, as I said a little bit earlier, a REIT stands for Real Estate Investment Trust, and the acronym is REIT. And it has been around since around the 1960s, and it was actually created by Congress in order to give all individuals the opportunity to really benefit from investing in income-producing real estate. So a real estate investment trust, it allows you as the investor to buy or finance properties the same exact way that you would invest in other sectors of the stock market. So here's an easy comparison for you so you can visualize it. Think about a REIT this way. In the same way shareholders benefit by owning stocks in other corporations, the stockholders of a REIT earn a share of the income produced through real estate investing without actually having to go out and buy or take hold or finance the physical property. REITs are typically categorized into one of two categories. These are the main two. There's equity REITs or M-REITs, and I'll explain the difference of those just so you feel confident if you run across the two variations. So an equity REIT, this really owns a lot of different types of commercial properties like office buildings or shopping malls, apartment buildings. You get the point. Equity REITs get the majority of their income from the rent that is charged on the properties that's owned inside of the trust, the real estate investment trust. Now, an M-REIT, it can own a combination of residential and commercial properties, and the M at the beginning, that actually stands for mortgage. So this can be an easy way to remember that an M-REIT they really base their real estate investing off of the mortgage market. And what that means is that an M-REIT buys mortgages on the secondary market, and the majority of the income from the M-REIT actually comes from the interest that's being charged on the mortgages that are being held inside this trust. So now that we know the REITs are trusts that own some form of property and income is produced from those properties, and the stockholders of the REIT either get their income from rents or interest, now let's talk about some more specific aspects of REITs, which is really, like I mentioned earlier, including the pros and the cons of investing in them. So let's first talk about the pros. I like to focus on the positive first, and then we'll get to, of course, the risks and the cons that are associated with this type of investment vehicle. But first, starting with the pros. So REITs really offer investors the benefit of commercial real estate investing, along with the advantages of investing in a publicly traded stock. So it's kind of a 2-for-1. The investment characteristics of income-producing real estate has provided REIT investors with historically competitive long-term rates of return that really complement the returns from other stocks and from other bonds. Now, REITs are required to distribute at least 90% of their taxable income to their shareholders, you as the investor, and they have to do this on an annual basis in the form of dividends. Significantly higher on average than other equities. The industry's dividend yields historically have produced a steady stream of income through a variety of market conditions, which makes it really attractive. In addition to the historical investment performance and portfolio diversification benefits available from investing in REITs, REITs offer several advantages typically not found in companies across other industries. Now, these benefits are part of the reason that REITs have really become increasingly popular with investors over the past several decades. REIT's reliable income is derived, as I mentioned earlier, from rents paid to the owners of commercial properties whose tenants often sign leases for long periods of time, because you're thinking it's business owners, right? We're not on month to month, which can make the income derived from these rents to seem more reliable. And also the income, as we know, derives from interest payments from the financing of those properties. So depending on what type of REIT you're investing in. Now, most REITs operate along a straightforward and easily understandable business model. You're leasing space and collecting rent on the real estate. The company generates income, which is then paid out to the shareholders in the form of dividends. And then when reporting financial results, REITs, like other publicly traded companies, must report earnings per share based on the net income as defined by generally accepted accounting principles. So it's pretty straightforward. In short here, REITs over time have really demonstrated a historical track record, providing a high level of current income combined with long-term share price appreciation. You've got inflation protection, and prudent diversification for investors across the age and investment style spectrum. Okay, so now that we have talked about all of the pros when it comes to REITs, we know that we, of course, do have to cover the cons and the risks that are associated so you can weigh and measure for yourself if this type of investment vehicle is best suited for you. But before we go into the risks associated with a REIT, we are going to take a short sponsor break, so don't go anywhere. Okay, I am so excited to share this episode's sponsor with you, WYLD Gallery. Now, WYLD is an Austin, Texas based gallery that exclusively features spellbinding, original, one of a kind Native American imagery that really explores heritage, culture, and tradition. WYLD carries a variety of art, including oil on canvas, acrylic, prints, and even posters. Several of the artists featured at the gallery have paintings in the permanent collections of museums like the Smithsonian and the American Indian Museum in Washington, D.C. and New York City. And I went on and I checked out the art, and I am honestly blown away. I found a piece called The Black Sun that is to die for. It is a beautiful pop of color that would look beautiful in my home. And what I love is that WYLD carries art for every budget. And what a great gift for the holidays to give your loved ones a one-of-a-kind museum quality piece of art. The art is honestly mesmerizing, and I highly recommend that you go check out the website at www.wyld.gallery to start shopping for beautiful one-of-a-kind art today. Well, welcome back, everybody, and I hope you enjoyed that short sponsor break. So now it's time to get into the cons or the risks that are associated with real estate investment trusts. I know that this was listed as a pro of a REIT, but it can also be a con, which is the fact that REITs are required by law to pay out 90% of their income in the form of dividends. So let me explain that. The 90% payout often acts as a double-edged sword for REIT investors. For one, the rule limits future growth, right? Because particularly with the best REITs for income, because the government requires the company to distribute 90% of its income to the shareholders, little capital is left over for acquiring or renovating new properties. So in most cases, the federal government taxes dividends at a lower rate than ordinary income. This is another risk or con that might be associated with this type of vehicle. But unfortunately, with REITs, the shareholders, that dividend tax benefit does not apply to their REIT holdings. And because of this, the government defines these distributions as ordinary income. This means investing in the best REITs for income will likely result in a much larger tax bill or tax consequence for the investor. Now, depending on your particular tax bracket and your income level, this could push you up into a higher tax bracket, which is something to consider, and definitely you need to consult with a CPA and a wealth advisor when and if you're seriously considering investing in a REIT. Also, property taxes usually become a REIT's most significant tax concern. Owners have to pay all of the required taxes on properties, and in an environment of rising real estate prices, this likely means greater tax expenses, and this possibly could mean less income to distribute to the shareholders. So if you're an investor in a REIT, you might also want to lessen your exposure to high property tax states. Something to consider is, for example, REITs that invest heavily in states like California, Illinois, New Jersey, Texas. These states would likely feel the most effect. Okay. At the beginning of the episode, I told you that we were going to talk about what a REIT is exactly, the pros and the cons of a REIT, and then when it would be a good time to consider investing in a REIT. So, as with any investment consideration, I have to tell you, I sound like a broken record, but you have to talk to a professional when you are considering something like this. They can deep dive your income, your taxes, your investment objectives, your specific time horizon. But generally speaking, if you are going to want to consider a few things prior to really pulling the trigger on a REIT. So just think about these things. First and foremost, have you eliminated all high-risk debt, meaning all credit card debt, debt to collection agencies, things that are in collections already? Make sure that your assets versus liabilities look good prior to making investment decisions. Now, let's say that you don't have any high-risk debt and you have a qualified retirement plan through your employer. Are you maxing out those contributions each year? This would be accounts like a 401k, a 403b, and the current limit as of 2020 is $19,500 per year for a 401k. And most employers also have a match program, which is essentially free money being left on the table if you're not taking advantage of that already. Another thing to consider here, depending on your tax situation, you would need to look into if a traditional or a Roth contribution makes the most sense for your particular situation. So definitely research both of those options. So now let's say that you've eliminated all high-risk debt. You're maximizing contributions into qualified accounts. Now it's time to look at non-qualified accounts. This would be an investment account where you contribute after-tax dollars to the account and you invest those funds. An example here would be a brokerage account or, as posed in the question at the beginning of the episode, a Roth IRA. Like in the original question that we just talked about, that seems to be a popular investment vehicle that you can consider buying real estate investment trust shares. So if you're at this point in your investment journey, a key thing to remember is diversification. My number one piece of advice would be to consult with a professional so they can help you diversify your portfolio properly and to keep it continually balanced. But if you're a DIY type of person, you have to remember that diversifying your money is the name of the game. Your exposure in equities, which most REITs fall into this category, need to be aligned with your investment objectives and your time horizon. I mentioned this in a previous episode, but a good rule of thumb is that you should subtract your age from 100, and that's the percentage of exposure that you should have in equities. So, for example, I'm 32, and that would mean that 68% of my portfolio should be in equities, or no more than 68% of my portfolio. REITs can be a fantastic addition to your portfolio and a really good way to diversify your money. But make sure that you do your research and then factor in the risks that could be associated with you and what could really affect you personally depending on your income and your tax bracket, those things that I mentioned earlier. So to circle back to the original question, considering a REIT as a newbie to investing could be a great option. Check out the specific REIT you're considering and make sure that you look into the projected income and how that could really affect your overall tax bill at the end of each year. Also check and see if it's a traded REIT or if it's a non-traded REIT, which can make a huge difference in how liquid the investment is and your ability to access your money if you should ever need it. Now, before we end this episode, I want to highlight a recent review that was left by someone named Rob, and I'm going to probably butcher the last name, but it's Bejuska? Sorry, Rob. I'm sure that I butchered that, but Rob said, "Clear, concise, and very informative. Thanks for the guidance. Keep up the great work." And I just thank you again. Thanks, Rob, for that. Sorry that I probably butchered your last name, but thanks for the review. And guys, if you haven't already, make sure that you go subscribe to the show, rate and leave us an honest review. It really does help the producers and myself know exactly how to curate the episodes to be what you guys are looking for. Let us know what you like. Let us know what topics you want to hear about more, what you don't want to hear about. Let me know what you think. Also, the episode that I released previous to this one was a guest episode, and make sure that you send me an email. It's financiallyfreejourneypodcast@gmail.com. Let me know what you thought about that format, because usually, of course, I'm just speaking myself, and I rarely have guests come onto the show, but I want to know if you guys want to hear more from guests, if you like that. So let me know your thoughts there, and that way we can incorporate more guests if that's something that you guys enjoyed. So thanks again for tuning in to today's episode. And if you're not already, make sure that you're following us on Instagram. It's @financiallyfreejourney, and you're going to get more tips and motivation to help you on your financially free journey. Until next time. Let's take a moment to thank this episode's sponsor, Podcorn. Now, as you all know, I am a huge advocate for pursuing your passions and creating multiple streams of income. Well, this podcast is my passion, and by generating income through the show, I'm able to continue to support the show and create more content to share with all of you. Now, Podcorn is a dedicated platform that connects podcasters to amazing podcast sponsorship opportunities like topical discussions, giveaways, interviews, or host-read ads just like this one. Now, with Podcorn, there's no middleman, which means that you get to retain complete control of your show and the brands that you choose to collaborate with. Podcorn also makes sure that you're protected and compensated for the work that you do. I have personally had the opportunity to review brands that are looking to collaborate on podcasts and handpick what brands I wanted to feature on my show based off of what I thought all of you guys might enjoy hearing. Now, having transparency, full control, and creative freedom freedom is a value that Podcorn and I have in common, which is why I love using their platform. Click the link in my show notes to sign up with Podcorn and start browsing sponsorship opportunities today.